Welcome to the Stock Market Palantir. Today we are going to talk about QCLS. So QC Technologies Inc., trading under the ticker QCLS, presents a fascinating and, to be frank, a very high-stakes case study in what you might call a chameleon corporate strategy. This isn't just a simple pivot, it's a radical, almost existential shift, abandoning anti-aging pharmaceuticals to leap entirely into what they now market as quantum-class photonic computing.
And that radical shift immediately sets up the central tension we have to explore today. The goal here is pretty clearly to capture those massive valuation multiples that, deep tech names have been enjoying. But the narrative feels profoundly unstable. On one side, you have this pure technological optimism, the quantum FOMO, as you call it, which just assumes the pivot is genuine and disruptive. But on the other side, you've got the baggage of an extremely toxic capital structure and, frankly, a documented history of shareholder destruction. So the real question we're debating is whether the future potential can possibly overcome that financial past.
Well, the market's initial reaction suggests that the potential is at least compelling enough to drive some pretty significant engagement. We can see this immediately if we just look at the microstructure, look at the recent trading behavior, especially that heavy clustering of volume between the $4 and $5 range in early December. That's not just accidental noise.
I agree the activity isn't accidental, but we have to read those tea leaves very, very carefully.
Precisely. And when we analyze the specific off-exchange trading, the institutional interest, or, at the very least, market maker activity, is undeniable. Let's just cite the data from December 2nd, 2025. The total off-exchange volume was nearly 50,000 shares, 49,294 to be exact. And the short volume ratio was a significant 43.33%. This heavy flow in dark pools signals that smart money is actively engaging with QCLS around these key levels. And my position is that this active engagement is overwhelmingly skewed toward distribution, not accumulation. I maintain that the company's, frankly, gruesome history of equity destruction and the crushing dilution overhang make the recent price action nothing more than unsustainable hype.
This whole corporate metamorphosis is, I think, a cynical strategy designed to reload capital before the structure inevitably collapses under its own weight.
I see why you'd focus on that historical risk, I do, but I'm going to argue that the sheer disruptive nature of the light solver LPU technology they've licensed, combined with the extreme technical setup, I'm talking about the low float that resulted from all the prior splits, outweighs that historical baggage. For a speculative, high-growth investor, QCLS represents a really significant opportunity. The downside is clear, sure, but the parabolic upside is what the technical structure promises.
Okay, well, let's unpack that technological promise first, because that's the engine that's driving this entire narrative. And I have to say, I'm skeptical that this pivot is fundamentally sound.
My thesis really starts with the idea that QCLS successfully escaped its identity as just another failing biotech shell. This repositioning into quantum-class photonic computing is, I believe, a genuine strategic move to access the hypergrowth multiples that are afforded to deep tech names. Look at IonQ or D-Wave. They trade on potential, not on current revenue. QCLS is aiming for that cohort. And the absolute key, is the exclusive global rights they secured for the light solver laser-based processing unit, the LPU.
The LPU.
Yes, the LPU. Its core application is designed specifically for energy-efficient cryptocurrency and blockchain operations. Now, why is that so crucial? Because for proof-of-work mining, energy efficiency is the single most critical factor that determines profitability and scalability. If LightSolver delivers on its promise of vastly superior energy efficiency, that market opportunity isn't just enormous, it's immediate and it's transformative for the entire crypto infrastructure world. That is a very compelling statement of potential, but I would argue that potential is built on, sand. When you actually look at the company's history, moving from Ackers Biosciences to MyMD to TNF Pharmaceuticals, it has been a relentless campaign of value destruction. So the thesis isn't that they might fail, the thesis is that the current valuation is deliberately divorced from any financial reality. The quantum narrative is simply a sophisticated, updated marketing strategy used to attract a new generation of retail capital. Just look at the facts. QCLS is pre-revenue. The 10Q for Q3 2025 shows essentially zero product revenue. This is a development stage company relying entirely on belief, but they are building credibility around that belief. The appointment of Dr. Stephen Frankel, a highly respected academic from the Technion, as a senior quantum advisor, that adds real substance beyond just marketing brochures. It signals a serious intent to actually commercialize the technology. And while I agree the fundamentals are weak, the technical setup is what matters for the current stock action. After the 1-for-100 split back in September, the current float is just razor thin, only about 4.17 million shares.
That low flow is a direct consequence of years of destruction, which brings me right to my core point.
Wait, just let me finish on the technical catalyst. A float that low, when you combine it with thematic tailwinds like the sympathy rally effect from the broader quantum sector, creates explosive conditions. I mean, we saw QBT rise 134% in December alone. That low float acts as kindling. Any retail capital chasing that thematic hype creates the potential for a parabolic short squeeze.
I understand the technical analysis, I really do. But the kindling is made of the ashes of prior investors. You can't talk about the low float without acknowledging the terrifying number that created it. The devastating cumulative reverse split ratio. We're talking 1 for 22,464,000 since 2013. The scale of that is, well, it's difficult to even comprehend. It means the equity value of any shareholder who held stock before 2024 was mathematically eliminated.
This is not just a growth strategy that didn't work out. It is a long-term, calculated reliance on wiping out old equity just to keep the corporate vehicle afloat. And this strategy continues to taint the balance sheet today. Out of their $37.2 million asset base, over two-thirds, more than $24 million, is intangible. $14.1 million for the technology license and $10.5 million in goodwill. If the light solver LPU fails to commercialize or the quantum market stalls, that entire asset base is an immediate impairment risk. You're asking investors to bet on intangible potential against a very, very tangible history of failure. That historical baggage is heavy, there's no doubt, but the market is pivoted, and the focus is now entirely forward-looking. So the core debate then has to be centered on the substance of this light solver technology. Is quantum class photonic computing just a brilliant rebranding, or does the LPU represent a genuine technological leap?
We must draw a very clear line here. I challenge the very term quantum class. We need to distinguish between pure quantum computing, which uses qubits and requires cryogenic temperatures, the model pursued by D-Wave and IonQ, and QCL's quantum-inspired photonic computing. This distinction is absolutely critical. Pure quantum aims for fundamentally different computational paradigms. QCL's is using lasers and light, not qubits.
And why is that so important to the commercial argument?
Because it risks being just skillful marketing. The LPU branding, it sounds deliberate, like it's mirroring the success of the GPU. They are capitalizing on the retail excitement around the word quantum without necessarily delivering the breakthrough that's associated with true quantum mechanics. It just smells like a maneuver designed specifically to exploit retail interest.
I acknowledge the marketing is genius, but let's look past the buzzwords for a second, to the commercial application. You're absolutely right that quantum-inspired is not pure quantum, but that distinction might actually be its strength, not its weakness. The very fact that the technology operates at room temperature eliminates the crippling infrastructure cost of cryogenics. This gives QCLS a viable and potentially near-term commercial path.
A near-term application of what exactly?
Combinatorial optimization problems. These are the highly complex calculations required to make proof-of-work mining efficient. So, if the LPU can deliver the massive leap in energy efficiency that it claims, that directly addresses the largest hurdle for industrial-scale crypto operations. In that specific niche, the disruptive leap is real. The market values potential for energy efficiency, and if QCLS is the company to deliver it, even if it's inspired and not pure, the stock is going to react violently.
But we're still betting millions on a license agreement for technology that hasn't proven itself commercially viable. And the appointment of Dr. Frankel, while it looks impressive on paper, feels like a strategic hire
designed to put a respectable face on a speculative gamble, rather than signaling a massive development commitment. It's true they're pre-revenue, but bringing on a known academic lends credibility to the underlying science that goes beyond simple marketing. They are effectively saying, look, we have serious research backing this pivot, not just a new corporate name.
Okay, let's shift focus then to the market mechanics, because I think they offer a more objective view of how established players perceive this risk-reward calculation. You pointed out the institutional interest shown by that dark pool clustering around $4 to $5. You argued these levels act as a magnet or a support for their entry. I did, and that's generally how institutional order flow works. When large volumes are executed in dark pools, and we saw the $7 million private placement led by Pharmasite Biotech occur near those levels, it establishes a vested institutional interest. These players are committed at those price points, and they tend to defend them, which provides a temporary floor.
I'm sorry, but I just don't buy that straightforward interpretation of the dark pool data when we overlay the extreme short volume ratio. I come at it from a completely different perspective that paints a picture of aggressive distribution.
Tell me how you interpret the ratio then. Well, let's look beyond the 43% on December 2nd and look at the peaks. The ratio frequently went over 50% in November, and it peaked dramatically at 64.19% on November 18th, 2025. This isn't neutral engagement, it signals institutional betting against the rally. In the context of dark pool trading, an extremely high short volume suggests that market makers are aggressively stepping in to provide liquidity by selling short into every single retail buying spike. So they're fulfilling the buy orders, but they don't believe the price is sustainable.
Exactly. Retail traders, fueled by this quantum FOMO narrative, they buy shares. Market makers meet that demand by creating shares, by shorting, and they anticipate that they can cover those shares later at a substantially lower price when the inevitable dilution or momentum loss hits. This is a classic indication that institutions are distributing stock, capping the price rise, not accumulating with any conviction in the long-term value. They are using the retail surge as an exit liquidity event.
That's a compelling argument, but if they are selling that aggressively, wouldn't they also need to accumulate some shares to hedge their positions or to eventually cover their shorts?
They will, but it's the net flow that matters. When you see consistent high short ratios accompanying every major rally, it establishes a ceiling. The retail buying pressure is fighting against a wall of institutional supply. And the fundamental reason that wall even exists brings us right back to the overwhelming supply risk, the dilution overhang. And we have to address this as it is absolutely the most significant, tangible risk facing the stock right now. It's the existential threat. We need to focus on the company's recent SEC filing, the registration to sell 6.51 million shares of common stock for existing selling shareholders. Now, let's put that number into stark relief. The current float is only 4.17 million shares.
This registered sale represents a potential flood of supply that is over 150% of the current public float, a 150% dilution event just ready to be deployed into the market at any time.
And it's not theoretical dilution. This is registered supply waiting for liquidity. That massive supply explains better than any other factor why the price rallies consistently fade. Every single time, the retail enthusiasm drives the price up. The registered shareholders or their affiliated entities have an overwhelming right to sell into that surge, ensuring the price is capped and driven right back down. It's a fundamental supply and demand imbalance that is mathematically, well, it's very difficult to overcome.
I acknowledge that the dilution risk is severe, and yes, mathematically proven to cap rallies. I'm not convinced, however, that it is an insurmountable obstacle for a volatility trade that's fueled by pure speculation. I would argue that this overhang exists primarily to fund the transition and the development required for this complex new technology. Investors buying QCLS are not investing in cash flow, they are buying an option on volatility.
An extremely expensive option.
Yes, but the volatility created by the low float combined with retail quantum FOMO That pervasive belief that QCLS could become a 10-bagger means the stock's parabolic potential might temporarily absorb that supply. If the cryptocurrency markets continue their rally, retail sentiment for QCLS, which is highly correlated with Bitcoin's movement, could create enough buying mania to briefly absorb that delusion. It's a high-risk game of chicken where technical momentum temporarily defies the financial reality. The volatility itself becomes the product.
But even if momentum temporarily absorbs the 4.17 million shares, what happens when the remaining 2 million registered shares hit the market? The moment the momentum stalls, the underlying reality, that weak balance sheet leveraging intangible assets, it reasserts itself, and the price collapse is inevitable. The market makers with their high short ratios are simply positioning for that highly probable outcome.
It is an extremely leveraged bet, but is one that offers an asymmetric reward profile if the technology even partially delivers. And no financially sound, established company offers this kind of potential percentage return. They simply don't have this kind of technical setup coupled with an explosive thematic pivot. The high risk is directly proportional to the potential reward.
I disagree on the proportionality. I believe the risks of a total loss vastly outweigh the probability of success. But I do understand the calculation if it's based purely on volatility. So, to summarize my position, QCLS represents a massive leveraged bet that's anchored almost entirely in intangible assets, the $14.1 million technology license and the $10.5 million in goodwill. This foundation is fueled by a narrative rebranding that strategically ignores the company's destructive history, crystallized by that shocking 1 for 22.4 million cumulative split ratio. The extremely high short volume ratios, peaking above 64%, are a clear signal of institutional skepticism regarding the current valuation and the sustainability of all this hype.
And I would reiterate the unique opportunity here. QCLS has successfully and very aggressively reset its valuation parameters by pivoting directly into the hyper-growth quantum and crypto infrastructure sectors. The light-solver LPU technology could indeed be genuinely disruptive to energy-intensive proof-of-work mining, offering a viable near-term commercial application for quantum-inspired tech. Coupled with the extremely low float structure, a direct result of that necessary financial restructuring, QCLS possesses the technical kindling for explosive, albeit volatile price movements driven by speculative retail capital that's chasing the next major thematic shift.
This case study truly demonstrates the market mechanics, where fundamental analysis violently clashes with technical speculation and, institutional maneuvering. The material really demands that any investor weigh the technological potential against the forensic financial history.
It's complex, it's high risk, and it requires extreme vigilance. But it offers a powerful example of what happens when narrative and microstructure align to create extreme volatility. Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.